Hello and welcome to the Legal and General Just Covered podcast. Today we've got another one of our specials where we're listening to advisors' news and views around different types of the intermediary space. And today we're looking at later life lending. My name's Wayne.
And I'm Hazel, and we're really excited to have a little look at the later life lending space and how advisors can really enhance their skills in that area. And to help us do that, we are joined today by Mike, who is an advisor for Mewstone Later Life. So welcome, Mike. Thanks for coming.
No worries. Thank you.
Yeah. So do you want to start us off just by telling us a little bit about your journey as an advisor and how you really got into the later life space?
Yeah. So my background really is retail banking. So I kind of started, and funnily enough, on the way in, I was talking to Joe, who I've come with today, about my journey and how I started. So I started 16 odd years ago now, working as a cashier in a building society, and kind of worked my way through the bank in loads of different positions over the years, and eventually kind of ended up at mortgage advice. And when I worked in the building society, because it was still that kind of time where you'd go in, you'd sit down, you'd speak to your advisor. I kind of learned quite quickly that actually I really enjoyed talking to older clients, because sometimes you're literally the only person they've seen all day. So you can sit down and have a nice chat and just kind of watch the world go by. So when I moved into mortgages, I kind of lost that a little bit. It became quite transactional, and I wanted a change. And I decided to move into the world of kind of later life mortgages. So dealing with borrowers over the age of 50 who need some type of borrowing. So I joined a brokerage in 2019, who specialised in later life lending, spent 3 or 4 years there, became equity release qualified whilst I was there, and then decided to sort of take it a step further and join Mewstone, who were looking to build a later life lending arm of their business. And so I started there just at the start of this year. So I've kind of gone on this journey of working from cashier in the bank, done more or less all of the stuff that you could have done there before I moved into the kind of the dark side of the broker world. And then, now I've gone to Mewstone.
I couldn't agree with you more. So my background's really similar. I was a building society background as well.
Great.
And
we're going to get on fine then.
But I definitely agree with you that when you look at the kind of later life space, and how to converse with those clients is completely different, I guess, because my main take from the switch over from standard lending into equity release when I did it was you've got mortgage people who are coming for a standard mortgage want it done yesterday, don't they? They're like, I urgently need this through, and it's all very busy, quick. Whereas actually the minute you go into the later life lending space, it's a completely different, almost different timescales, isn't it? And so how did you find that? Yeah,
I mean, I think my later life clients, they have the life experience to go with it. If you remember back to perhaps if you bought your first home, it's really stressful, isn't it? You've got all these things that are going on, all these things that are happening, and you kind of have to try and decipher what everyone's saying. And unless you've got a good broker behind you, sometimes that can be really difficult because brokers are often the glue that kind of seals it all together. Whereas I think later life clients, they're less concerned about the process in a sense of, they've been through this before, they've bought houses in the past. And slowing that process down, I think, is actually the right way to go about it, because it means that, ultimately the advice that you give is more considered because they've had more time to kind of, think about the things that you've been talking about, make sure they're really happy and comfortable. And, vulnerabilities and things like that, they are more prevalent in later life lending. There are more vulnerable clients, I think it's fair to say, in the later life space who, the fact that you're not always up against it to deliver within this really, predetermined timescale that might have been set by an estate agent or a solicitor or what have you, it just gives you more time to understand that client. And I think that is the most important thing, because it's not as transactional as you may find like the more mainstream mortgage market is, in my opinion.
So I was going to say, do you find that particular clients, if you like, sometimes have been mulling over the idea of going, doing some sort of later life lending before they come to it?
Yeah, I think that, most of the time when you're dealing with the mainstream market, they've come to you because this is what I'm doing. And unfortunately, sometimes it even gets to a point where they've already decided this is what they're doing before they actually know they can. I find in the later life space, clients are more considered, they have thought about their options, and that always then opens the conversation up to talk about those alternatives as well, because when you're considering what's best for your client, it's not just about the borrowing options that are out there. Sometimes it's the non-borrowing opportunities actually that are more, they're a better outcome for the client. So they may have already thought about the possibility of downsizing to raise some capital. They may have considered perhaps a further advance with their current lender. Maybe they have a mortgage left over at the moment. There's all these different things that they're probably mulling around in their head, and they have done for some time. So when you get the opportunity to kind of get into that conversation and into that dialogue, my first port of call really is to establish what have you already done, because we need to work out where you are now to then how I'm going to advise you going forward. So I definitely think there's more consideration when older clients are thinking about their borrowing options.
And there's a lot going on, isn't there, for them? They're thinking about care, care provisions going forward, thinking about what they want to happen to the home if one of them was no longer there, the risk of that. It's a huge, obviously you think about that in a standard mortgage, but I guess in the later life space, it's far more prevalent to them, isn't it? Because they're closer and closer to that time of life of potentially having some huge changes in the home, such as one of them needing care, one of them potentially passing away. And it's a completely different nuance in the conversation, isn't it?
Yeah, I find, and the point around, one of the borrowers passing away, I appreciate this is all, these things aren't predetermined. They happen when they happen, but there is more consideration. And quite often one of the things that I'm asked the most is, what happens if my partner passes away? What happens if my spouse passes away? They're more concerned about the person that they'll leave behind than what would happen if it happened to them almost, and obviously with things like lifetime mortgages, that's not so much of an issue, because actually that guarantee of tenure is there, and that differs from some of the other later life lending options, or even your conventional mortgage options. There are lenders in the conventional space that will lend into clients' 70s, sometimes 80s, that don't necessarily make provision for what if one of those incomes disappears. And in this day and age, when we look at the typical pension provision, we're still in a place where one party's pension provision will die with them. So the whole point of affordability and checking affordability, yes, it's a good thing, and by checking affordability, you're making sure that mortgage is affordable now and in the future. But I think sometimes the lenders models may be a little bit not quite, what's the word I'm looking for? They don't quite dive deep enough. Yeah, it's not quite fit enough for purpose for that individual sometimes, is it? Think about their risk and the things happening. Because I'm in the retirement space now, and I work in our annuities space, and we're definitely seeing that as more and more people have less income as they reach that point. More and more people are wanting stability later in life than maybe what they had in the past. When we look at typical, mortgages and drawdown. So we're seeing, we've had a case recently where there's been somebody approaching to do equity release, but they're using it to buy a care annuity. So then it's like those two products working really together to provide that stability. Whereas if you went to a mainstream kind of lender or didn't come to an advisor for that, that's maybe a potential opportunity missed, for that client. And it's actually really interesting that you say that, because I think, as the later life market evolves and we start to see, some of the innovation that's coming from products, and also the kind of the crossover between pension provision and borrowing into retirement, there really needs to be, I think, that joined up approach is becoming more important than it perhaps ever has been, because when you're thinking about a later life lending option, it would be so wrong of you to not consider how that might impact, pensionable income, how that might impact intergenerational transfer of wealth, that kind of thing. There's all these different things that I think, and some of the ways that the industry is changing now, as well as I think people are starting to think about the kind of more rounded package rather than just equity release, which is always the first thing that when people talk about later life comes to mind. This is this product that does this and that. I think that when we think about how to ensure that our older borrowers are protected, and even just our older clients across the board, these are all kind of tools in your box. And I think that advisors as a whole probably need to consider those things more now than perhaps they might have done 5 years ago, when interest rates were kind of that much lower, and when there was that kind of stability in the market and the product was there and being used because it was seen as kind of cheap. We're not necessarily in that space anymore, and I think that having that kind of overarching point of, I need to make sure that all these needs are covered, rather than just focusing on my client wants to release £20,000 to buy a new car. You've got to think that much further ahead now.
It takes it away from being a transaction, doesn't it? And it makes it like a really sound kind of almost life coaching for the customer when it comes to finances and what they can do and things. So you do
like
become a bit of an agony aunt sometimes, don't you? You do.
I think you do. And people who are in this position, they've come to you because they trust you. And the last thing you want to do is kind of break down that trust. So you have to think about those wider issues. It's not just about ensuring that you are able to satisfy the need. It's what are the implications of my recommendation, and how are they going to affect this client over this lifetime, which isn't predetermined. You set up a mortgage for 30 years. You know that if that client doesn't do anything with it, in 30 years' time, they would have paid their loan off. That's great. Lifetime mortgages, the entry point now at 55, there's no set date there. It could go on forever. And you've got to make sure that you're staying there. You're not just there at the time when you set it up. It's all about, how are we making sure that this client is looked after for the rest of their life. And it's just such an important part of it.
We're very passionate about it. It's
Absolutely.
lovely to see how you really care. And how you mentioned the market's changed. Obviously, we all know that, our kind of annuities, it's been great for me, the interest rates. But obviously for yourself in that environment, how have you had to adapt your approach, or have you had to adapt your approach? How have you managed to get clients in a period of lower, those rates being a bit higher, the payments not being, as you said, as cheap as they once were?
I think that, as a whole, the days of I want to buy something because it's cheap, that we're just not there anymore. I think when I speak to my clients about later life lending as a whole entity, it's about what this is going to do for them. So I don't necessarily think that my approach has changed. It's just obviously that it's going to cost potentially a little bit more in the way of interest if they're allowing it to roll up, or if they're going to service it, the payments are going to be higher. But, the need is still there. And I think people are, and going back to the question you asked about, are people kind of mulling things over? Yes, they absolutely are. And this is, I think the result of that is that when we finally get to a position where a client has built up the trust, perhaps you've spoken to them over the course of 2 or 3 meetings, and they've then come to you and said, right, I think it's time now. You've had that period of them building up to it, but also then you're just able to kind of look at all of those options and be in a position where, you, like I said, you can be more considered, and you can look at all of the avenues before you eventually decide on which way you're going to go.
Because they're more considered, the fact you mentioned that some of them are asking around those eventualities, the what ifs, it sounds like, unlike, we talk to a lot of protection advisors and stuff, and you're talking to customers around the what if scenarios. Yeah. It sounds like customers are thinking about that anyway. They're already asking you, and that's where your knowledge, your skill, your expertise comes to the fore, because you can explain about that wider impact on their portfolio, like you say, the intergenerational planning, all that type of thing.
And that's it, isn't it? Because like I say, when you're talking to first time buyers about protecting their mortgage, sometimes that can be met with some objection, which is bonkers, isn't it? Because, they've potentially got a 90% LTV loan, and their employment income, which is never guaranteed, is the only thing that's supporting that loan. And they're quite flippant almost as to say, well, why do I need this? Whereas, clients that have been through this journey already, and they've seen home ownership, they might have suffered loss in their family. They've got to their 50s, they're in a position where perhaps they're looking towards retirement. Whether they can or can't at that moment in time, sometimes is yet to be seen. But all these things they've experienced already, so they know the questions that they want to ask you. They're not worried about, what if I don't get this mortgage? Because actually what's more important to them is making sure they get the right thing. So they, again, they slow things down. And, my style is very much to make sure that my clients are well supported, and they're at a position where they're almost telling me what route we need to take, because I've been able to spend that time to go through all those options with them, and then we can together draw a conclusion on what is the best route for you. Yeah,
it feels like a consultative style, doesn't it? Very sort of laid back, if you like, for want of a better way of describing it.
Yeah.
And you've got, I suppose, with those particular customers, do you have any scenarios where, over a period of time, where they've mulled it over and they might have ended up at a decision they're going to, the path they're going to take, one is more pro doing something in the later life lending space than the other?
Do you mean what, as far as which solution that they ultimately want to take?
Yeah.
I mean, sometimes, and what's really, really interesting is that, equity release as a term is people assume, oh, this is going to mean this and that for me. And quite often when I'm kind of, that consultative style, as you've mentioned, when I'm talking to clients about their options, a lifetime mortgage could be option 3 or option 4 on the things on in terms of priorities. That could be like the 4th thing on the list as to what they could do to fulfill that need. And quite often when you talk through the pros and the cons of, for example, the capital and interest mortgage, the retirement interest only mortgage, what about hybrid? What about PTLM? What about downsizing? It's number 5 on the list, but actually when you talk through the pros and cons and what that means to that client in that particular space, if they're mandated to service their interests versus the opportunity to be flexible in that approach, they still end up thinking, well, actually, do you know what? This lifetime mortgage, it has, all the benefits of security of tenure. If my situation changes, if one of us does pass on, I'm not going to be in a position where I'm committed to continue to make these payments, because no one really knows how a bereavement is going to affect them until they're there. You may want to downsize. Well, the 3-year compassionate redemption windows there, there's options. Lifetime mortgages are actually really well thought out, and I think that it's all these other little features that are often overlooked. Clients are very quick to go, well, what's this going to cost me? And that is what it is. No one can change that. It's all the other things that the lifetime mortgages do that can actually make up the basis of a recommendation for a lifetime mortgage over a capital and interest or a RIO. And
you're right to flag the fact that we talk about it a lot when life happens. If someone is bereaved, they could be thinking very, very differently, as you mentioned, about things than they were before. Yeah. So they could have had 30, 40, 50 years in that particular property when they were with their partner or spouse or whatever. One of the last things they may want to do when they get there, I suppose when you're young, take the mortgage, build up, get a big property, I'll just downsize. Then you get there, think, I don't think I really want to do that. The kids grew up in the house or whatever, and I just don't really want the rigmarole of it, so I'm not going to do it. But again, things may change if someone dies. So I think you're right to highlight the fact that we've got this flexibility in these types of products. It is very forward thinking and very customer focused.
Yeah, absolutely. And with that, if you think about your typical first-time buyer, again, to go back to first-time buyers, but you have a predetermined term, you have a protection policy that pays out on the event of a bereavement or a critical illness or what have you. From an advisor's perspective who works in that market, if that eventuality comes about, the protection that's been set up to ensure that risk pays out, and then potentially they're not your client anymore, because what they initially came to you for, of I'm going to come to you because you're going to arrange a mortgage for me, that relationship's ended because they've suffered that bereavement, they've had a critical illness, it's paid their mortgage off. They're not in a position where you need to service them anymore. Whereas with a lifetime mortgage, you are that client's advisor for the rest of their life. I'm quite fortunate that, touch wood, I'm going to be in that position where I can speak to those clients and speak to those clients' children because I'm going to be there. And just because something has happened in their family situation, the relationship doesn't end, because more often than not, a lifetime mortgage isn't protected in the same way because of the way that you can forego making interest payments and allow it to roll up. Protection isn't there to repay the debt, so you're still there servicing that client or the bereaved client at the point where where they really need you.
And the process means that you will get in contact with the family anyway. The family are involved, aren't they? So you're already there with them. Mm-hmm. And in terms of that regular contact then, how does that work for your later life lending clients? How do you keep in contact? How do you keep that awareness going about what you're doing as an advisor and as a brand?
It's a 12-monthly thing for us. So, I'm checking in with my clients every year just to sort of say, how are things going? What's changed? What's new? Did you buy that boat? What one did you get? Do you know what I mean? That doesn't happen as much anymore as it perhaps did a few years ago, in fairness. Yeah. But it's an ongoing journey. It sounds really corny, but you almost want to become part of that family dynamic. You've already met the kids. You've been around to see the client, and you've seen the grandkids' pictures on the wall, and you know these people. They are people that you spent some time with, likely because they have been considering their options. So you've not just turned up at a mortgage appointment like you may do in the mainstream, service that client's need and kind of move on. It is very much like a journey, and there's always that continuation of that. And it'd be wrong of me to recommend a product for someone's lifetime and then not be there to make sure that product remains suitable for them. And that's obviously where Consumer Duty is highlighting that these kind of regular contact points need to be made. But I think any advisor that is thinking about their clients in the long term are probably doing this already just as part of their normal day-to-day work.
Yeah, it's so important, isn't it? Because what I find interesting about the later life space is we call it a lifetime mortgage, which maybe makes people think it's not flexible. So I guess it's interesting. There are all these little options, and throughout that product, that actually as an advisor you can continue to add value to what you do. You mentioned something when we caught up last time. So I think some advisors listening to the call would be thinking, or listening to this podcast, would be thinking, I really like equity release. I really want to get into it or want to be able to refer it, but I don't know where to start with my client bank. What would you say are the things for them to look out for? If they're doing standard mortgages at the moment and actually maybe they do have some clients coming up to 50 years old, what would you say are the key things for them to look out for? If they've got a client bank, they've got people in their approaching 50 or getting, products now can start from 50.
Sure.
What would you say they should look out for?
Well, I think that's exactly it, isn't it? Because, later life, 50 isn't actually later life. The way that technology is coming on, people are living a lot longer. There is a good chance. 18 is the entry point as a minimum for a mortgage. Is it fair to say that age 50 is later life? Well, it is for a lot of people. That's only halfway through the time they've been able to borrow money. So it is earlier. And I think any mortgage broker who doesn't do equity release as a product offering at the moment are probably in a really, really great position to start to do that, because the way that lenders are innovating their products now, and they're starting to look more at affordability and how much would be affordable for your client to pay, or let's look at a way of being able to extend what can be borrowed using earned income or pension income. Kind of mortgage brokers who operate in that mainstream mortgage market already, they do that now. This is their bread and butter. This is their everyday work. A lifetime mortgage or equity release is kind of quite fast becoming an extension of what's available in the mainstream. And obviously these kind of more flexible products that are out there help to kind of bridge that gap almost. So I think anyone who isn't qualified to give equity release advice at the moment is probably in a good place, because like I say, they know half of what the job is becoming. The other half is obviously the considerations of how do I deal with an older client? What things will I come up against that I might not come up against in the more kind of residential mortgage space? Like, what happens if one of your clients passes away? How does that wealth pass down to children, to grandchildren, etc.? So there are obviously some complications with the sector, but the whole concept of affordability and thinking about how can I put my client in the best position using the income that they have to support their loan, that's where we're heading, it feels. And
that's a really nice way to put it, isn't it? It's like, how can I best support with the income they have? Because that's the thing, their income's about to be probably changing quite a bit throughout that time. And,
this is it.
Regular mortgage might no longer be fit for purpose. Those hybrid products, our PTLM, that's exactly where they come into their own, isn't it? And having knowledge of those can really change a customer's life and they run up to retirement by freeing up income, can't it?
Exactly, yeah. And there is an element of desire, and there is an element of what the client wants as well. So this week I've written 2 mortgages for 2 different clients who are the same age, but they have 2 different types of mortgage, similar incomes, and it's because their kind of outlook on life is different. One client I've recommended a capital and interest mortgage for over a predetermined period, because they want to know that they can repay their mortgage before they retire, which is fine. And the other client I've recommended a retirement interest only mortgage, because actually the point of repaying their capital in their family dynamic isn't as important as it is for the other client. So, just because you have a set of numbers in front of you and a profile of a client, the fact finding and the work that you do as an advisor to dig deep into what motivates them, that's ultimately what spurs your recommendation on. So there is that extra kind of added point to it and that added skill to it. But the numbers bit, the bit that you spend hours looking at, working, well, who can I do this with, or who can we've all been there, we've all done that. The next step on is then how you kind of garner that relationship and ultimately recommend what's right for that client in the here and now.
It's the value. that you've shown there, isn't it? The value that you're showing with regards to getting to know that client, the whys and wherefores, how they feel about things, the challenges they've had. It's all about contributes to their psyche and their makeup and the way they are, doesn't it? So therefore, you're providing an appropriate recommendation based on what they want, what the outcome is. Again, the consumers you mentioned earlier on, they understand what they're going into, and you're there all the way through to ensure that they're getting a proper positive outcome.
Yeah, it's, you know, we are advisors. We're not just here to take a profile. It's not like doing your exams again and going, if only I could ask this one more question, I would know what to recommend. You know, we've got the beauty of doing that now because we're with clients, we're sat with them, talking to them every day, sometimes digging a little bit deeper and asking those couple of questions about them rather than their finances. That can ultimately change the route or the path that you may have thought you were going down. So yeah, it's for me, it's fantastic to be in a position where whatever client sits in front of me, I have a potential solution for them. The great and the kind of the exciting bit sometimes is finding out which one we're going for, you know.
And you mentioned family quite a few times. So we know the Equity Release Council really recommend that family should be involved right from the outset, because ultimately they'll be dealing with it all when, you know, that customer's no longer there anymore. Yeah. You mentioned when we spoke previously a really clever kind of way that you market out to clients, and kind of you look at potential. When you think about your standard marketing, you don't just market to those over 55. So do you want to talk to us a little bit about that? And
so yeah, I mean, it's perhaps a little bit tongue-in-cheek, but equity release is just a mortgage. It's an interest-only mortgage that can run for the rest of your life, and you decide if you pay it or not. That it's bold to say, but that kind of is what it is. And you know, even in the kind of the normal market, the typical mortgage market, interest-only mortgages are still available. So the fact that they can have this type of product isn't necessarily wholly exclusive to later life. And, you know, the great thing in the position that I'm in is that I do speak to younger clients as well. You know, I work across the whole market, so I can do more or less anything in the lending sense. But it is just an interest-only mortgage that you can take for the rest of your life. You don't have to. You can, like all mortgages, you can repay it. You don't have to make payments. If you do, that will benefit your estate. If you don't, then that interest is still going to be charged. It's just going to be added onto the loan. It's not dissimilar from what you get in the normal conventional mortgage market. You know, my typical client is between ages 55 and 70. They have an interest-only mortgage that is due to expire either now or in the next 12 months. They're fully aware of how an interest-only mortgage works because they have one already. And sometimes in the right scenarios, a lifetime mortgage is almost an extension of that interest-only arrangement because they are comfortable with the premise of paying interest on a regular basis, which in turn means that will prevent any compounding interest over time, which will ultimately help to preserve their estate. And I suppose the great thing now is that lenders are much more flexible in terms of what you can do with your payments. So you don't just, you know, you don't have to stop at just servicing interest. You can pay off a lifetime mortgage over a period of time using your overpayment allowance. So, you know, these are all features that clients who are not in the later life lending market, shall we say, they're used to having access to these features already. And the fact that now the industry is more aligned with the traditional mortgage market, it just means that when you're talking to clients about how they can impact the decision that they're making now, they relate to it, and these are things that they can already do. And then I suppose the big thing from that is making sure that with the regular follow-ups that you do with clients, that if they are in a position to be able to do that, they take advantage of those features.
And do you find that they do take advantage of it? So when I was advising, even actually a family members of mine recently actually looked at doing later life lending, and what we found with them is I was trying to explain to them that if you do a lifetime mortgage, you can still have optional payments, which will keep the balance the exact same. It gives you options, etc. But they were adamant that they didn't want to look at an equity release route, that retirement interest only was the way to go, and it was because they still didn't quite trust the equity release products are good for consumers. Do you still see some of that happening, and how do you get around it?
I think, yes, I do. It would be wrong of me to sit here and say that every client is not, is tuned on to the concept of equity release, because it doesn't have a great reputation. There were times where equity relief was a lot more restrictive, that there were these limitations on what you could and couldn't do, and there's still a hangover, if you like, in the industry of those times. We're still kind of riding that and dealing with that as advisors to educate our clients on the upshots and some of the benefits that come with it. Last week I went and saw a client post-completion to set up the standing order with them. And I think it all stems from how you manage that client's relationship. My client last week that I went to see, we discussed the impact of what happens if you don't make these interest payments over time. I also illustrated to them the benefit of them making those payments over time. They were happy that if in the future their situation changed and perhaps they couldn't afford it, we don't know what's going to happen with cost of living. We don't know what's going to happen with anything is also so changeable right now. So for them, as opposed to the retirement interest only mortgage where they have been mandated to make those payments, they were actually safe in the knowledge that if their situation were to change massively and perhaps they needed someone to come in and help with things like household task care, they're not then going to feel like they can't spend their money on that because they can reduce down what they pay on their lifetime mortgage. And, through regular follow-up, you make sure that your client is in the loop and they know where they stand with what they can and can't do. So again, I think it just all goes back to the relationship.
Isn't it? Because as you get older, you just worry. That's human nature. You worry more and more about everything, don't you? So you can imagine as you're going to something new again, the change curve. Oh, I'm going to worry about this. Yeah. What if the income reduces or whatever? What do we do? So it sounds like your role, even that post-completion point, has still got that real level of crucialness with regards to the pathway which they've taken.
It's funny how we, when we think about mortgage advice, it's always considered to be this kind of one tiny little bit in the process and the time that you spend with your client. But actually the advice you give your client is for every single interaction that you have with them, because you're always educating, you're always trying to ensure that their best interests are at heart, that you're trying to do the right things for your clients. You do that every time you pick up the phone to them, every time you meet them for lunch or whatever you do with your clients. You're always advising them on what is best for them. It doesn't just stem from the time where they signed a bit of paper to say that that's the recommendation that they've accepted. It is a lifelong
You're topping up that trust, aren't you?
Yeah.
Where every time, that each touch point that you have, galvanising it, however you want to describe it.
Absolutely. And often those kind of follow-up meetings and those opportunities to re-engage with a client, it's another kind of introduction to their family. And thinking about it from a commercial standpoint, once I'm building relationships with their family members, I then have a potential new client. So it's not just about, if you're thinking about how can I grow my business and how can I ensure that I'm helping as many clients as I can, all of the interactions that you have with your client can ultimately stem and lead to further interactions with their family. And, if I was recommended to someone by their mum, I would be making sure that I'm absolutely, top-notch service for that client, because if someone's mum's recommended me, you know what I mean? Like that almost feels like, I've got kids myself, like that almost feels like I need to make sure I'm on my A game here because this is Joey's mum that's recommended me. Do you know what I mean? So
they will tell their friends as well, won't they? And if you're keeping in contact with them so much like you're doing, it's the old saying, wasn't it? If you get amazing service, you'll tell your friends. If you get really bad service, you'll tell your friends. If it's mediocre, you're not really going to say. And that's what you want, don't you? You want them to be as energetic as you are about the solution you've provided, particularly if you've got people, as Hazel's already mentioned, that may have heard about equity release, heard all the bad stories back in the day and go, I wouldn't touch that type thing. And they might be saying, well, no, actually, I went through it with Mike and he did this and this, and potentially, you've got new clients, haven't you?
And even if equity release or a lifetime mortgage isn't the right option for that client, the great thing about working in this kind of later life industry and working across all these different products is that there is always something there's always a tool in the box. There's always something that I can use and something that I can help a client with. The big question, the big thing that is on everyone's mind is, do I trust the guy that's sat in front of me? to do the right thing for me. And I think, I pride myself on working with the whole market. I think that's really, really important, because actually that encourages innovation in the market. That encourages providers to really be on their A game and make sure that they're attracting advisors' business, which is a great result for the client, because it means that they've got more flexibility. They've got the, as far as the cost of their borrowing is competitively priced, it's priced in line with the market, and they've got all these cool features that they can use as well. And if you think further ahead than just equity release, all of this stuff is already out there. The big shame in all of it is that our demographic is still very, very, they're not inclined to inquire. They're not inclined to ask these questions because they're worried about, the possibility of ending up with equity release, where, again, the stuff we've spoken about over the last 45 minutes or so is all around flexibility and how there's so many options for clients now on what they can and can't do with the borrowing that they take.
Well, it's interesting, isn't it? Because you're drilled in, even when you very first go to a mortgage advisor as a first-time buyer, they drill into you, try and get the term nice and short so you can pay your mortgage off as quick as you can, so you can be debt-free to enjoy retirement. Yeah. So it's almost like drilled into you from a very young age in your house buying process that, it's bad to have a mortgage. As I get older, I want to get rid of that. So I guess as generations change and people are taking out their mortgages later and later, actually that's where equity release comes into its own, doesn't it? Because you then, that reputation is getting small, that it's kind of getting dulled down, isn't it, over time? And that's only positive as people live longer and will have even more need for those products. And the group
of people that need it is growing as well. Obviously we're looking at, as an industry, the speed in which interest-only mortgages are, these maturities are happening. So there are more clients out there now that need a solution that will take them into their retirement. There are some mainstream lenders that do their best to plug the gap, but then they're just not set up for lending on a C&I basis for the rest of people's days. That's not for them. That's not the business that they do. So, lifetime mortgage lenders and lenders that are willing to perhaps be a little bit more specialist and do later life lending, they have a different outlook on the way that they operate. But it just means then that your clients, there's somewhere for them. They're not just stuck like they potentially have been in the past. And what's really interesting is the kind of the hybrid products and the payment term product, all of these innovations that are coming to market, it feels like they are designed for the benefit of those types of borrower who can't, under the traditional equity release, attain the loan to value that they need. And the fact that lenders are actually out there looking to increase their offering, which I guess in turn increases their market share, that's great business for them. It means that my clients have got a home, and they don't have to leave their home. That's a win-win-win, isn't it? Right? Everyone kind of benefits from that. And that is, again, that's one of the things that if the kind of the general consensus was that later life lending is a good thing, that I think that message would be so much better heard. But it's still, sometimes you do find that you're in a position where you're almost having to defend why someone who is in their 50s will borrow money for the rest of their lives. But it's already happening. The great thing is that now we've got solutions for it.
And a lot of people don't have a choice, do they? The way that pensions and things are, and they, the way that rates have been, that'll have shocked some people. People could have been getting to the end of their mortgage, or they had a couple of more fixed rates to maybe lock into. Rates have completely changed. So throwing that whole timeline for them absolutely off, won't it? And I think that's where, again, it's so important. What I'm curious about, so obviously whole of market is really important to you, obviously, and to be able to provide your clients with that holistic approach is amazing. But I'm thinking, if some advisors are listening to this, they might think, how on earth does Mike remember it all? How does he keep his, how do you stay ahead of all these changes? And what do you do in terms of self-development and self-learning?
I think that's everything that you do, to be honest with you. The time that I'm not spent speaking to clients is time where I'm trying to further enhance my knowledge of the subject. It's funny, isn't it? Because actually in the kind of the later life space, there are considerably less lenders than perhaps the mainstream mortgage market. When I joined Mewstone back at the early part of this year, I started initially to take on some kind of general mainstream mortgage clients, and it was a nightmare. Honestly, it was because there are some real technical things that you do. And when you come out of that market and then you go back into it, it is, you've got to kind of put yourself back in there and remember, well, who does this and who does that? So you could argue that in the later life space, there is a much smaller population of lenders out there that do it. But because the products are so complicated, it only takes one small criteria change, and all of a sudden, your go-to for this or that they're gone. So you have got to keep yourself in the loop all the time. And that just comes from engaging with the industry. I heard a term from another advisor that I speak to regularly, and he referred to the later life market as a village. And it stuck with me, actually, because it is a really small village of people. Some people are lenders, some of the people that live in the village are advisors, and some of the people that live in the village are consumers. It is a small village, and you have to kind of build those relationships with your neighbours to get to a point where you're on top of what they offer and what they do, because everyone's unique. All lenders have got different attitudes to risk. They've got different reasons why they're in the market, and once you understand what makes them work, I think sometimes then that helps you to know how they can benefit your clients.
It's a village probably sat in between two big cities with mortgages, standard mortgages, and in retirement, wealth planning.
Yeah.
You're that bridge kind of in the middle, aren't you? Because you've got to know about enough about standard mortgages to be able to say to a client, you might be better placed there, go and have a look. But you also need to, using that annuity case as an example, you need to know enough about actually what's available in the retirement space as a whole, and the wealth planning and that intergenerational wealth and risk of, inheritance, that all those things. So it's a lot to take in, isn't it, and be knowledgeable on.
And I think, my personal aspiration for the next 12 months is become DIPFA qualified. And I think that in this market and in this industry, it's all about ensuring right outcomes. Consumer Duty has really, really highlighted that to us. And, to better my advice, I think that's my kind of logical next step, because then, like you said, it means that I can commute across to the city over here that deals with pensions and investments and so on and so forth, but still, kind of have some honour to the city that I've left behind, which was kind of, more mainstream residential mortgages. So I think that, as this concept of later life lending and how you protect intergenerational wealth, how you are able to do things like get children onto the ladder, all of that stuff, you have to be thinking about what's going on over here as well as what's going on over there, whilst trying to staying in your village as well. So it is all very, very closely interlinked now.
And the village will only grow with the innovation they reference to anyway.
They tend to get, that's what tends to happen, isn't it? They tend to become a part of a bigger city, and that, could well be that over the the next 5 or 10 years, as this becomes more commonplace and people are more, people are using later life options more and more to pay their mortgages off or help their children on the ladder or whatever the situation may be. As the town grows, more and more people are going to want to live there, aren't they? Because the stuff that place offers is good, and it just grows from there.
It's their dream lifestyle, isn't it? Well, whether it's lifestyle or, I guess later life lending's two extremes, isn't it? It's either the lifestyle, as you said, one of your clients buying a boat. I had one that bought a Bentley one time, and you just think but then you also have the clients who really need it. And they're the really financially vulnerable and need your help. So it's a lovely way that actually you're seeing a full breadth of society.
Yeah, and there's different feelings as well. When you've got someone the keys to that car or whatever that aspiration that they want to achieve, it's a really great feeling because you've helped them achieve something, and it doesn't go away from you. Like, it's still great that you've put them in a position where they can do that, but when you've been able to help someone stay in the property that they inherited from their nan or something like that, actually that's got a whole different feeling to it. And if these options went out there, that wouldn't be possible. That client would have to downsize. For some people it is just bricks and mortar, and that's fine. But it is for others, it is their life. That is where they've always been, and they're not ready to go yet.
So for any advisors listening, also we've covered an amazing amount of topics there about kind of self-learning, looking at vulnerability, how to build trust in your clients, your process. What would be the thing that was your key takeaway from being in this industry that you would advise to others?
I think be curious, go out and find out what you can and can't do. What's on offer, what's out there. The village thing again is it's not like a closed community. It's not oh, you know, I can't go and ask this, I can't go and do that. Like I speak to brokers all the time who ask me questions about, you know, well, I've got this client who's perhaps a little bit, you know, I assume I can't do anything. It's like, it's almost like I assume it's not going to happen. But that's just the polar opposite of where we are. So just be curious, ask the questions, go and speak to other brokers, you know, set up communities, engage with other professionals in this industry, because we can all, you know, collectively, everyone's got a specialism, you know, everyone is good at something. And there's no reason why anyone that's kind of worth their salt won't be willing to help and share that, because ultimately the more people that work in this industry, I think the more it strengthens the reputation. And then that means that client outcomes are improved. So that for me is like the big thing.
And that's where you started, wasn't it?
Yeah.
This conversation started that your clients at Building Society that you like, you know, that you warm to and like dealing with.
Exactly, being curious at that point.
Yeah.
Just one particular thing that has resonated with me today, in particular around that building trust with clients and stuff, is where if every advisor could sit and think, clients, when they're sitting in front of them for the first time, building that relationship with them, they're going to be thinking, is that person really putting me at the center of what they're doing? Have they got my best interests at heart? Are they really going to see things through and be there when I need them? And I just thought that was so powerful.
Yeah.
And if everyone could be thinking that, and a lot of advisors do actually, but to keep that sort of top of mind when you're first meeting your clients, that could really, really help everyone going forward.
Yeah. And, you know, like ultimately, if I help a client buy their first home, because like I said, I still work in that market as well, there's no reason why I can't continue to service that client for the rest of my lifetime. And you know, personally looking at where I aspire to be, you know, again, if we go back to how that could affect me on a commercial level, if I can arrange a mortgage for a client which then moves into later life lending, which looks at pension. So actually, you know, by working hard at those first time buyer clients and those clients that are perhaps new to the world of financial advice, if you do everything in your power to make sure that you give that client the best you can, there's no reason why you can't do that then for those other things in their later life as well. It's a journey, isn't it? You know, and I think the best impression that you make at the very start of that journey, the more likely you are then to build that trust and be able to continue that relationship through to, you know, everything else that applies.
Absolutely.
Fantastic.
Well, thank you so much for your time.
No worries.
It's been
Thank
lovely
you.
speaking to you.
Thank
And
you.
before we close, I just like wish you the very best of luck if you take on DIPFA.
Thank
Good
you.
luck.
Yeah.
I'm sure
Yeah.
there'll be many people listening that can lend a hand.